Picture this. It's a Saturday morning, and you're driving through a neighborhood you've always admired. The one with the wide driveways, the freshly painted shutters, the minivans parked next to the basketball hoops in the cul-de-sac. And you slow down, you can't help it, because you see a family outside. Dad's mowing the lawn, mom's planting something in the flower beds, the kids are running through a sprinkler in the yard. And you think, that's it, that's the dream, that's what I'm working toward. And something inside you just aches a little bit, because you don't have that yet. And you tell yourself, I just need to get there. I just need to get to that house. But here's what you don't see when you drive past that picture-perfect scene. You don't see the credit card statement sitting on the kitchen counter. You don't see the quiet argument they had last Tuesday about whether they should skip the family vacation this year. You don't see the $4,200 mortgage payment that hits on the first of every month and sends a ripple of low-grade anxiety through the entire household. You don't see the fact that their retirement accounts haven't been touched in 3 years, that the husband took on extra freelance work just to keep the lights on, that the wife lies awake at night doing math in her head, wondering how they're going to replace the AC unit when it finally gives out. From the outside, it looks like the dream. From the inside, it's a very expensive, very beautiful cage. My name's Nico, and I spend way too much time thinking about money. And if you're new here, welcome. This channel is where we talk about the real stuff, the uncomfortable stuff, the math that nobody runs for you before you make the biggest financial decision of your life. If that sounds like your kind of thing, hit subscribe, drop a thumbs up. It genuinely helps more people find these videos. And stick around, because what I'm about to walk you through today might completely change how you think about homeownership, wealth, and what it actually means to be financially free. And here's the question I want you sitting with from the very start. What if the biggest house you can afford is actually the biggest threat to your financial future?
Let me paint you a picture. Imagine you've got a bucket, and every month money flows into that bucket. Your paycheck, maybe a side hustle, whatever it is. Now the goal is to fill that bucket up over time, right? Build wealth, build options, build freedom. But here's the problem. Your house has a drain in the bottom of that bucket. And the bigger the house, the bigger the drain. We're not just talking about your mortgage. We're talking about property taxes, homeowners insurance, maintenance, repairs, utilities, HOA fees, landscaping, and the general gravitational pull of a big home that slowly, quietly, consistently sucks money out of your life every single month. And the drain is so normal, so expected, so baked into the culture of homeownership that most people never even look down to see how fast their bucket is emptying. Now, I want to be really clear about something before we go any further, because I know how this topic can land. I am not anti-homeownership. I'm not here to tell you renting is always better, or that buying a home is a scam. What I am here to tell you is that there is a specific trap, a psychological, mathematical, identity-level trap that millions of Americans fall into every single year, and it is quietly destroying their ability to build real, lasting wealth. And that trap has a name. It's called being house poor. The official definition of house poor is spending more than 28 to 30% of your gross monthly income on housing costs. But the real experience of being house poor is something a lot more suffocating than a percentage. It's the feeling of having a beautiful home and an empty bank account. It's being asset rich and cash poor. It's owning something that looks like success from the outside, but feels like financial quicksand from the inside. And here's where it gets really interesting. Recent surveys suggest that nearly 40% of American homeowners currently meet some version of this definition. 4 in 10 homeowners. Not some rare edge case, almost half.
And the average new home buyer today? They're stretching further than ever to get into that home. The median home price in the U.S. has exploded over the last decade. We're talking about a reality where the average first-time buyer is locking in a mortgage payment that, when you add taxes and insurance, clears $2,500 to $3,500 a month, sometimes more in many major markets. On a household income that statistically sits somewhere between $70,000 and $100,000 a year. You do the math on that. At $80,000 a year, you're taking home maybe $5,500 to $6,000 a month after taxes. And if your housing costs are eating $3,000 of that, you've got $2,500 to $3,000 left for literally everything else. Food, car payments, insurance, childcare, student loans, retirement, fun, life. That's not a budget. That's a pressure cooker. So how does this happen? How do smart, educated, well-intentioned people end up in homes they can technically afford but practically can't? Because this isn't a stupidity problem. This is a psychology problem, and it starts way earlier than the closing table. It starts with something called the forever home fantasy. At some point in our cultural programming, we absorbed this idea that buying a home is not just a financial transaction, it's an arrival. It's a statement about who you are and where you've landed in life. And not just any home, the home, the one with the good school district, the open floor plan, the extra bedroom for guests, the yard for the dog you don't have yet, the office for working from home, the dining room for the dinner parties you're going to host. We don't buy homes for the life we're living. We buy homes for the life we imagine we're going to live. And the mortgage lender is more than happy to finance that fantasy.
Here's a wild one for you. Studies on homebuyer behavior consistently show that people spend an average of just 6 to 10 weeks actually shopping for a home before making an offer. 6 to 10 weeks to make a 30-year financial commitment, but they'll spend months researching a laptop purchase. Think about that. We agonize over a $1,200 MacBook and then sign a $400,000 mortgage after 2 months of open houses and one emotionally charged Sunday afternoon. The psychology of the home buying process is specifically engineered to override your rational brain. The staging, the warm lighting, the fresh-baked cookie smell, the agent who says things like, "This one won't last," and "You deserve this." It's not an accident, it's theater. And then there's the classic bank approval trap. The bank says you're approved for $600,000, and suddenly $600,000 becomes the floor of your search, not the ceiling. Because if the bank thinks you can afford it, right? Wrong. The bank's job is not to protect your financial future. The bank's job is to approve you for as much debt as their risk models will allow. They're in the business of lending money, not building your wealth. The fact that you qualify for a payment doesn't mean you can thrive while making it. And thriving matters, not just surviving, thriving. Now let's get into the math, because this is the part that will completely reframe how you think about this. And I promise you, if you actually sit with these numbers, something is going to click for you in a way it never has before. Let's talk about two fictional people. Let's call them Marcus and Jamie. They're the same age, 32, same income, $90,000 a year. Both have about $60,000 saved up. Both are ready to buy a home. The only difference is the choice they make.
Marcus buys the bigger house. He stretches into a $520,000 home in the neighborhood he's always wanted. With a 20% down payment, he's putting $104,000 in. Wait, he only has $60,000. So he puts 10% down, which is $52,000, and now he's carrying private mortgage insurance on top of everything. His principal and interest payment alone is around $2,900 a month at current rates. Add property taxes, insurance, and PMI, and he's all in at about $3,500 a month on housing. He's got maybe $1,800 to $2,000 left over each month for everything else. He can technically make it work, but retirement contributions get cut back. The emergency fund never grows. Any unexpected expense, a broken water heater, a medical bill, goes straight onto a credit card. Jamie buys a more modest home, $320,000, puts 15% down, $48,000, which she can swing. Her all-in housing cost comes to about $2,100 a month. Same income as Marcus, but she has $1,400 more per month in breathing room. She puts $700 a month into her retirement accounts and keeps the other $700 as real, spendable financial cushion. Now, here's the part that will blow your mind. That's $700 a month going into Jamie's retirement account. If it compounds at a historically modest 8% annual return over 30 years, turns into roughly $1.04 million. Over $1 million just from the difference in what she chose to do with the money she wasn't overspending on housing. Meanwhile, Marcus, who is in the bigger, more impressive house, has been treading water financially for 30 years. He's got equity in his home, maybe, but he's got no real investment cushion, no real freedom. And the worst part? The lifestyle inside his big house never really changed. He still eats at the same restaurants, still watches the same Netflix. The house that was supposed to represent the good life actually made the good life harder to access.
And I haven't even talked about the opportunity cost of the larger down payment, because that extra money tied up in a bigger down payment, money that could have been invested, is also money that is no longer working for you in the market. There's an old saying in personal finance, your home is not an investment, it's a place to live. The equity in your home is relatively illiquid. You can't spend it. You can't easily access it without another loan. And historically, home appreciation has averaged somewhere between 3 and 4% per year, which barely keeps up with inflation and dramatically underperforms a diversified stock portfolio over long periods of time. Let me tell you about the Garcias. Real story, different names because I respect people's privacy. The Garcias were a couple in their mid-30s. Two incomes, combined about $130,000 a year. They had been renting a nice two-bedroom apartment for about $1,700 a month and living pretty comfortably. Then they had their second kid, and suddenly the social pressure became deafening. Family members started making comments about roots and stability. Their friends were all buying. Their neighbor posted a video on social media of their home reveal and got 10,000 views. The Garcias felt like they were falling behind, like they were failing somehow, even though by any objective measure they were doing really well. So they bought. 4-bedroom house in the suburbs. Nice neighborhood, good schools, the whole thing. $580,000. Their all-in monthly housing cost hit $4,100, and almost immediately, everything tightened. They stopped going out to dinner as much, they paused their retirement contributions, just temporarily. They told themselves they'd get back on track once they got settled. That was 4 years ago. They haven't gotten back on track. They've gotten used to it. They've normalized the tightness. And here's what scares me about the Garcias story. They're not in crisis. They're not going bankrupt. They look fine. They look successful. But they are quietly, slowly, invisibly falling behind on building real wealth. And they don't even fully know it because nobody's running the numbers for them.
That normalization piece is so important, and I want to spend a minute on it because I think it's the psychological key that makes this trap so hard to escape. There's a concept in behavioral psychology called hedonic adaptation. The idea that humans are extraordinarily good at adapting to new circumstances, both good and bad, and returning to a baseline emotional state. Which sounds great in theory, but in the context of a too big mortgage payment, it means something really specific. It means the anxiety and the tightness of being house poor becomes your new normal. The elevated stress level becomes background noise. You stop feeling the weight of it the same way you did at the beginning. And because you've adapted, you stop questioning whether the choice was right. You just keep going. This is what I sometimes call the forever home fog. You bought the house, you've committed to it emotionally, socially, financially. Your identity is now tied up in being a homeowner in that neighborhood, in that zip code, the school district, the commute, the neighbors you're starting to know. Leaving feels like failure, so you don't question it. You just figure out how to make it work.
And making it work, more often than not, means quietly sacrificing the things that would actually build your financial future. And here's the crazy part. The house itself starts to demand more from you over time. This is what researchers call the Diderot effect on steroids. When you move into a bigger, nicer home, suddenly the furniture you had doesn't look right. Your old couch looks shabby in the new living room. The kitchen feels bare. You need a dining table that fits the dining room, curtains for the extra windows, furniture for the guest bedroom, art for the walls, rugs, light fixtures. And none of these are frivolous purchases. They feel completely reasonable and necessary, but they add up fast. Studies have shown that the average family spends somewhere between $10,000 and $30,000 on furnishing and upgrading a new home in the first 2 years of ownership, on top of the mortgage, on top of the move itself. It's like the house has a gravitational field that pulls money toward it.
And then there's the maintenance reality that nobody talks about honestly enough. The general rule of thumb in personal finance is that you should budget between 1% and 2% of your home's value every single year for maintenance and repairs. On a $500,000 home, that's $5,000 to $10,000 a year, not if something goes wrong, just as a baseline expectation of what it costs to keep a house running. Roof, HVAC, plumbing, appliances, siding, windows, these things wear out, and they do not wear out on a convenient schedule. They wear out on the worst possible day, at the worst possible time, and the bill shows up whether you saved for it or not. Most American families have less than $1,000 in savings available to cover an emergency expense. Think about what that means for the family in the house that cost $500,000. Now, I want to flip this conversation for a moment, because this video isn't just about fear and math, it's about possibility. Because here's the identity shift that I think is the most powerful and the most counterintuitive thing I can offer you today. Downsizing your home or choosing a smaller home from the start is not a step backward. It is one of the most sophisticated financial decisions you can make. It is a power move. And the people who understand this, really understand it at a gut level, become an entirely different kind of wealthy. Think about what your life actually looks like when your housing costs are genuinely affordable. Not theoretically affordable, not bank-qualified affordable, actually, comfortably, sustainably affordable. You stop thinking about money constantly. You start sleeping better. You contribute to your retirement without hesitation because you have the margin. You build an emergency fund that actually functions as an emergency fund. You have the freedom to take a risk on a new job or business idea because you're not terrified of missing a mortgage payment. You can take the vacation. You can be generous. You can help your kids. You can say yes to things that matter to you without doing financial gymnastics first. There's a version of wealth that looks rich and a version that is rich. The version that looks rich drives the expensive car and lives in the impressive house and has roughly zero financial breathing room. The version that is rich might live in a house that raises no eyebrows at all, but they have compounding investments, an emergency account, zero high-interest debt, and the freedom to make choices based on what they want instead of what they can afford to lose. The second version is so much better, I promise you. The second version is what we're building toward here. And look, I want to address the people who are already in this situation, because I know some of you are watching this and feeling a knot in your stomach because what I'm describing is your life right now. First, no judgment, none. This trap exists because the entire system, the media, the banks, the real estate industry, the cultural narrative of the American dream is designed to pull you toward the bigger house. You didn't fall for something stupid. You fell for something powerful and pervasive. And recognizing the trap is genuinely the first step out of it. If you're already in a house that's stretching you thin, you have options. You can look at whether refinancing makes sense. You can look at renting out a room or a portion of the property. You can get aggressive about eliminating other debts to free up monthly cash flow. You can look at whether downsizing, actually selling and moving somewhere more affordable, makes financial sense for your situation. I know that last one is hard to even consider. The social cost of moving out of a neighborhood, of downsizing, feels enormous. But I want to ask you a genuine question. Is the discomfort of what people might think worth more than your actual financial freedom? Is maintaining the appearance of success worth the reality of financial stress? Because that's the trade you're making if you stay in a house you genuinely can't afford.
And for those of you who haven't bought yet, maybe you're in that period of deciding, maybe you're saving up, maybe you're on the fence, you are sitting on a genuinely rare and precious thing: optionality. The ability to make this choice thoughtfully, without the pressure of an existing mortgage, is something you should guard with everything you have. The rule I always come back to is this: buy the house you need, not the house you could technically qualify for. Go in at 30 to 40% below your maximum approval. Make sure the all-in payment, mortgage, taxes, insurance, and a realistic maintenance budget sits comfortably at or under 25% of your take-home pay. Not your gross income, your take-home pay. The money that actually shows up in your account, because that's what you're actually living on. And don't let the market pressure you into the bigger purchase. I know it feels like you need to act, like you'll miss your window, like houses only ever go up. But the house that makes you house poor in an appreciating market is still making you house poor. The equity that's building in your wall is not the same as the freedom that's building in your brokerage account. Here's where it gets really interesting as a final thought. The compounding that everyone talks about in investing, it applies to habits and identity just as powerfully as it applies to money. Every month you choose the affordable home over the impressive one, you are compounding the habit of living below your means. You are compounding the identity of someone who prioritizes freedom over optics. You are compounding your financial margin, your investment returns, your peace of mind. And 10 years from now, 20 years from now, you are going to be a fundamentally different person, a fundamentally more free person than the version of you who bought the biggest house the bank would let them have.
You become the kind of person who doesn't check their bank account with dread, who doesn't calculate whether they can afford to get sick, who doesn't feel their stomach drop when the car makes a weird sound. You become the kind of person who has options. Real options. And real options are the closest thing to real freedom that money can buy. So the next time you drive past that picture-perfect house in the nice neighborhood, remember what you don't see from the street, and ask yourself what kind of wealth you're actually building. Because the goal was never the house. The goal was always the life. If this hit home for you, and I genuinely hope it did, drop a comment below and tell me where you're at in your housing journey. Are you already in it? Are you thinking about buying? Are you deliberately renting to build wealth? I want to know. Every comment you leave tells the algorithm that this content matters, and it helps me keep making these videos for you. And if you want to go deeper on this stuff, the psychology of money, the math behind wealth building, the decisions that actually move the needle, there's a whole library of content waiting for you right here on this channel. I'll see you in the next one.